We have products as X, Y, and Z. Then the production is given, budgeted production. Budgeted production is given to us as 200. Then we have 400 and then 300. And each unit requires machine hours as 5, 6, and 2. So let's write machine hours per unit. 5, 6, and 2. So how many total number of units are required is what has to be calculated. So let's work it out, that one. Total hours would be the product of these two things. So the total output of 200 into 5. Add them up. So the total hours required is 4000. Now we have two components, variable component, fixed component, and they are given as per unit, per hour, the rate per hour. The total number of hours are already calculated as 4000. So once we have this, we can calculate what is the variable component of the overhead and the fixed component of overhead. So let's work it out. Variable overhead is the rate is 2.30 into 4000.
9,200.
Then we have the fixed component. Fixed overhead is also given to us as 0.75 per machine hour. Just take that and multiply into
3,000.
0.75 into 4000.
3,000.
Add them up, and that's the total overhead cost. This is a very, very basic model. You would get to work out maybe at a later stage when you are looking at some other advanced paper. You get some other adjustments also. Maybe at this level, this is sufficient, but then you get to understand when you do cost accounting and other topics, how do we calculate overheads? There may be certain other adjustments as well, right? Then coming to the next question, question number 292, which is there on the screen. Vincent is preparing a cash budget for July. His credit sales are as follows. April, May, June, July. For these months, we have the credit sales given. His recent debt collection experience has been as follows. There are certain percentages mentioned. How much may Vincent expect to collect from credit customers during July? Cash budget is not an operating budget. Cash budget is a finance budget, financial budget. So under financial budget, we have capital budgets, then we have cash budget, and then apart from that, there are certain forecasted statements. One is forecasted balance sheet, that is we call it as a pro forma balance sheet. Maybe sometime later you will come across these terms. We have that as a budgeted balance sheet and also a budgeted cash flow statement. These are the things which are prepared under financial budgets now. So now, what is the purpose of preparing cash budget? So one of the budgets is, see, each budget we have looked into what is the need. Sales budget is to understand how much revenue has to be generated to meet their objective of maximizing their profit. So sales, then to sell that many number of units, how many units have to be produced? To produce that many number of units, how many units of material has to be purchased? Then labor cost, then overheads. This is what we have looked into. Then what is the purpose of preparing cash budget? See, we understand that cash kept idle does not multiply. You put 1,000 in a box, open it after 1 year, also 1,000 will remain same 1,000 only. See, cash in hand, cash at bank doesn't multiply much. The interest rate what is received in a savings account is very, very, very minimum. So technically speaking, it doesn't multiply much. Okay, so what does the business do? The business invests this cash amount in some investment, some project, some asset, some way the amount is invested so that some return can be earned. Okay, because cash does not give any return. That's one aspect of it. The second aspect of it, if cash is not available, they will not be able to make the payments to the creditors for operating expenses for any purpose. Cash is needed. If everything is invested, okay, someone has a very big mansion and no cash in hand, how will they survive? How will they meet their expenses? That again is a issue. So also in a business, everything, if it is invested into assets and projects and proposals, all those things, if they do not have cash in hand, how will they run their business? So that is an important thing again. So a cash budget helps in understanding how much is the requirement of cash periodically. So whatever is the period for 1 month, 1 week, 1 quarter, 1 year. So technically speaking, it is for the immediate current period. Cash budgets are prepared to understand what is the requirement of cash. How do they understand what is the requirement of cash to make the payments? How much cash is available? Now we've already understood that most of the time cash is not kept available, but cash is in circulation. So when they sell goods, cash is received. So it is an ongoing process. So they invest amount in material, they buy material, they convert it into finished goods, and they sell. When they sell, they get cash. So it is an ongoing process of cash investing and cash receiving back. Fine. Now, what is their main source of revenue? How do they receive cash? Is by way of selling goods. So if it is cash sales, immediately they will receive. If it is credit sales, after the end of the credit period, if the credit period is for 1 month, at the end of 1 month they receive the amount. So it is a continuous process of receiving cash. So how much cash is received in each period is what is first looked into. So the first step is they find out what are the cash receipts. How much are the cash receipts is the first thing what is assessed. After that, what are the cash payments? Why are payments needed to be made? Payments are needed to be made to the supplier who supplies the material, the creditor who supplies the material, to make the payment for rent, salaries, wages.
Excuse me, ma'am.
Yes.
Ma'am,
Yeah.
ma'am, your voice is coming so low.
Just allow me. I'll put a headphone and then talk to you. Just allow me 1 second. Check if it is fine. Is it fine?
Yes, ma'am.
Yes, ma'am.
Yeah. Also check what is the sound in your device, whether it is at maximum or not. Please check that.
Yes, ma'am, it's in maximum and now it's fine.
So, what is the requirement of cash is what, how do we understand what is the requirement of cash is? See what are the sources from which cash is received. So the main source of cash receipt is sales. After that, what are the payments which have to be made during that period? Maybe the amount has to be paid to creditors, okay, rent and other things. So other operating expenses also have to be paid. So now looking into these things about how much cash is received during a period and how much are the payments which have to be made, after assessing that, they can understand whether they have more cash, that is they have surplus, or they have deficit. So what is surplus? When the receipts exceed the payments, we call it as surplus. If the payments exceed the receipts, we call it as deficit. Okay, deficit. Um, if there is surplus, okay, then they are fine, they don't have to worry about it. If there is a deficit, maybe some arrangement, some short term loan has to be raised, some way in which cash has to be arranged so that they will be able to meet all their payments on due date. If the payments are not met on due date, the reputation of the business gets affected. So that is a problem, that is an issue with the business. Therefore, to ensure that they can meet all their payments on the due date, they should have sufficient amount of cash available with them. That is the objective behind why cash budget is prepared. Done. Now here in this case, this question, we are asked to calculate how much may Vincent expect to collect from the credit customers. It's only about the first part of it, that is the the cash receipts, how much they can expect from their customers. What type of customers? They are credit customers, which means that sales were made on credit basis to the customers. Now, what are the terms of credit? Here, these are details given about what are the terms of credit. All these figures from April to July, April, May, June, July, these are all credit sales. I hope you have noted down that. So it says that his credit sales are as follows. So April 40,000, May 30,000, June 20,000, July 25,000. What are the terms of credit? The terms of credit are current month sales are 20%. He's collecting the amount, debt collection experience. So if there is one figure, let's say this is 40,000, 40,000 is for 1 month sales. So out of this 40,000, the payment would be 20%, he will receive it in the same month, okay, in the current month sales, same month. Then another one, 60% in the, okay. The terms of condition are, here it is not, this is collection experience. So 20% of it is from the same month. So same month sales, 20% of the sales are from the same month. So whatever is the amount, it is related to the same month. Let's say that if we start from July, so July's 20% will be received in July only. Okay, 60% of the previous month, prior month will be, this will be June. 60% of June sales will be received in July. This is the collection pattern which is given. 20% of July's sales are collected in July itself. And in July, they collect 60% of June month's sales, because June they made credit sales, and 60% of that amount is collected in July, because we are asked to calculate what is the amount collected during July. So the same month, current month sales, 20% is in July, 60% is in June. Prior month is prior to July is June. Then sales 2 months prior. 2 months prior is from July. If we take 2 months prior to that, it is May. So May month credit sales, 10% of the credit sales is collected in July. 5% of the debts are uncollectible. So we can ignore uncollectabilities. It is bad debts. Okay. So shall we prepare the amounts and then calculate that? I hope you understood the logic.
Yes, ma'am.
So let's start with that. July month sales. July month sales, how much, what percentage are they collecting? They are collecting 20% of July month sales. So what is July month sales? It's estimated to be as 25,000. So 25,000 into 20%. Okay. Then we have the prior month, which is June. June month's sales are collected as 60% in July. So June month sales are 20,000. So 20,000 into 60%. Then we have before June, it is May. May month's sales are collected as 10%. So 10% of May month sales are 30,000 into 10%. Add them up.
Ma'am, this is collected in July.
So cash collected during July is 20,000. I hope all of you got it, and then please make a note of it.
Yes, ma'am.
We'll work out the next question. Question number 293 is there on the screen. Please look into this. DRS projected revenue for 20X9 is 28,000 per month. All sales are on credit. Receivables accounts are settled 50% in the month of sales, 45% in the following month, and 5% written off as irrecoverable debts after 2 months. What are the budgeted cash collections for March? Now, let's start. Cash collections during the month of March. Shall we start? The terms are DRS projected revenue for 20X9 is 28,000 per month. And then it says all sales are on credit. Then the receivables are settled as 50% in the month of sales. So if in a month the amount of credit sales are made, 50% of the amount comes back in the same month, 45% in the following month, and 5% are written off as irrecoverable debts after 2 months. What are the budgeted cash collections for the month of March? I don't know whether you are able to follow this one or not, but technically we need to first understand the projected revenue for 20X9 is 28,000 per month. Okay, 28,000 per month is the sale. Now every month it is uniformly the same. All sales are on credit basis. So this 28,000 revenue is on account of credit sales, right? Receivables are settled 50% in the month of sales and 45% in the month of March, in the following month. So if we are looking at March, March will receive amount in the month of March, and collection will be from the previous month also, because 45% in the following month. So if in 1 month, let's say in 1 month, the first month, if the amount of sales are made, the collections will be in the first month, okay, in the second month as well. So it's spread over 2 months. So if they make sales in January, the collections will be there in January and February as well. That is the point here. So if they are making sales in 1 month, they will collect the amount in the same month and in the next month. So if we are talking about collection, February will collect February month's collection. This is collection. February will collect the amount of February and also from the previous month, because once the amount is sold in January, the payment, a part of the amount will be collected during the next month. So the next month is February. So February will receive a percentage of February sales and a percentage of amount of the previous month, which is January. So that is the logic here. Now, which month are we talking about? March. So, if amount is collected during March, cash collections. So we are looking at what are cash collections. Cash collections of the March month will be collected. Cash collections of the previous month, which is February, also will be collected. Okay. How much of the amount of the same month will be collected? How much amount of the same month will be collected?
50%.
Okay, 50%. Done. So 50% is how much?
Ma'am,
Yeah.
14,000. What is the month of sale, ma'am?
Ma'am?
Yeah. Please.
Ma'am?
Yeah.
Ma'am, can you explain this point once again, please? Ma'am, this January and
Ma'am?
February.
Okay, we will not
We can
take.
expect the January collection in the month of March also, no, ma'am.
Let's
If
not take January, February. Let's take March only. If we are talking about March, okay, 50% in the same month of sale.
Ma'am, what is the month of sale, ma'am, here?
All through the year from January to December, they would be receiving revenue. January, February, all through the year, on an average per month, their sales made are 28,000. January, February, March, so on. Okay, so each month, a part of it, January will receive the amount from customers, in a part of it in January, a part of it in February.
ma'am, it is also possible that they can receive in the month of March also.
One part is received in January, one part will be received in February. How much will be received in January? 50%. How much will be received in February?
50%.
45%. So here it is 50%. This is 50%. And this is 45%.
Ma'am, why 45%?
It is given, no, following 45% in the following month. Following month is the next month.
Okay, ma'am.
Okay.
Ma'am, when it comes to February,
February, a part of it will be received in February. Okay. The sale of February, collection will be in February and March. Okay, so February, how much will it receive? 50%. March, it will receive
45%.
Okay, so this is how we keep writing. The question is not about I mean, what are the sales made or how it is spread over. The question is very specifically about the collection. These are the collection pattern. So if we are looking at March will be a part of it, 50% of March.
April 45%.
Done. So March 50%.
5% is the
Uncollectible, bad debts. Okay. March, a part of it goes to April. So how much is collected in March? March will be having 50% of
45%.
March sales, 45% will go to April. So we are asked to find out how much is collected during March. So there are two Marches here. Do you see that? 50% of March, 45% of April will be collected during March. Do you see that?
Yes, ma'am.
Okay. So now when we write this, the solution, March sales amount which is collected is 28,000 into 50%. Yes.
But isn't he asking what we are receiving in March and not what we should, like, what is the March collection and not what we are receiving?
Collection and receiving is the same, no?
But why are we taking February month's
Because
collection?
February, 50% of February will be received in February, collected in February, collected from the customers or received from the customer. It means the same. So 50% anyway would be received in February, but the balance of it will be received during March. So we want to know how much is the total amount collected during March. That is the point. So February also sales are 28,000 into the percentage is 45%. So here it would, yeah.
5% are written off after 2 months. So after
So technically that is not collected at all. So when it is not collected, we would not write it in cash budget. So it will not be collected. So when it would be written off and what is the journal entry, it will be taken care in the books of accounts later on. But for us, the focus point here is how much cash is collected during the month of March. So during the month of March, part
So,
of it,
ma'am,
yeah.
ma'am, for February, 45%, we are considering that February month as March.
That's right.
Okay, ma'am.
So the total amount of cash collection during the month of March is 26,600. Then we have another question, 294. All of you, please make a note of the solution for 293 because I'm going to erase the screen, the one which I wrote it with a pen. I will erase it and then we have to scroll down to 294. Okay, let's look into the solution for 294. A company anticipates that 10,000 units of product Z will be sold during January. Each unit of Z requires 2 liters of raw material W. Actual stocks as of January 1 and budgeted inventories as of 31st January are as follows. Rajeshwari, is it clear? The solution for the, you've
Yes,
asked me
ma'am.
to, okay, done. I just
Thank
saw
you,
the
ma'am.
chat now. Okay, it says that actual stocks as of January 1 and budgeted inventories as of January 31 are as follows. So the product Z units are 14,000 and 12,000. Raw material W is in terms of liters is 20,000 and 15,000. 1 liter of W costs 4. If the company pays for all purchases in the month of acquisition, what is the cash outlay for January purchases of W? Cash outlays. What is the cash payment? What is the cash payment for January purchases of the raw material W? So they are producing, make a note of the details. They are anticipating to produce 10,000 units of product Z, but this product will require, Z requires 2 liters of raw material W. Done. Actual stocks as of 1st January and budgeted inventories are given here. We have the final output, which is the final product, which is product Z. Then we have the raw material W. The opening and the closing stocks are given. The question is, if the company pays for all purchases in the month of acquisition, what is the cash outlay? So how do we proceed further? How do we answer such a question? What are they purchasing? They are purchasing raw material Z, raw material W. They are purchasing each unit of Z. They're purchasing raw material W. To produce the product Z, raw material W has to be purchased. So when W is purchased, W for the amount of the value of W has to be paid to the suppliers. If the company pays for all the purchase in the month of acquisition, same month, whenever they purchase in that same month, they are making the payment. Same month, the payment is made. If all the purchases are paid in the month of acquisition, what is the cash outlay for January purchases of W? What is the cash outlay? Okay. How much did they purchase is the issue here. Why? Because there are some opening stock material available. Considering the opening stock, the rest of it only they will purchase, isn't it? They already have the opening stock as on 1st January. But how much do they require is what we have to know. How do we know what is the requirement? Requirement will be understood only when they know what is the production. Raw material needed for production, because every single unit of Z requires 2 liters. So if they produce one unit, they will require 2 liters of material W. If 1 unit of Z is produced, 2 liters of W is required. So totally how much do they require is what we have to understand. So step number 1 is we have to find out what is the requirement of material W. For that, we need to know what is the production taken up. Question number 294. Step number 1, unless and until they understand how many units are produced. How many units are produced? Again, considering the opening stock and closing stock. So production budget. I hope you remember what is the equation for production budget. How do we write? How many units to be produced? What's the equation? Starting point is
Plus
that's right.
stock plus
Sales.
stock.
Okay. They are
Plus
anticipating. That's
monthly
right. Okay. They are anticipating to sell how many units? They are anticipating to sell 10,000 units. Then add closing stock. How many units of closing stock do they have? Closing stock is 31st January. 12,000 is the. Okay. So then add it together. We have 22,000. From this 22,000, less the opening stock minus opening stock.
14,000.
So opening stock is how much? 14,000.
14,000.
Okay, so this is number of units to be produced. So 8,000 is the requirement. 8,000 has to be produced. So if they are producing 8,000, so then they have to understand what is the requirement.
$16,000.
Okay. So they will require now how many units of raw material has to be purchased. So requirement will result in the purchase. So purchases budget. For the purchases budget, then we need to know what is the equation for purchases budget. It looks similar to the production budget equation only. The material required for the production, okay, material required for the production will be 8 into 2, as you have said, 16,000 plus they have some opening stock of 20,000 liters is already available and the closing stock of 15,000 is there. Fine. So the same logic we apply here. So raw material requirement, here we are finding out what is the purchases budget. So raw materials requirement is equal to 8,000 into 2. Fine. Add closing stock. Closing stock is 15,000. Then less opening stock. Material to be purchased. So once they purchase the material, they are making the payment in the same month. So that again is there. All the material which is purchased in a month is expected to be paid in the same month. If the company pays for all the purchases in the month of acquisition, what is the amount of cash outlay? What is the cost of these material which is purchased? The cost of material which is purchased is at 1 liter of W cost 4. So cash outlay is equal to 11,000 into 4, which is equal to 44. Please make a note of this one. We'll go to the next solution. The next one, question number 295. A company has 2 months receivable cycle. It receives in cash 45% of total gross sales value in the month of invoicing. Invoicing is billing. Okay, when the bill is made, and that in that case, it says that 45% of the total gross sales value is received in the same month in which the bill is prepared, or technically in the same month when the sales are made. Irrecoverable debts are 20% of total gross sales value, and there is a 10% discount for settling accounts within 30 days. What proportion of the first month sales will be received as cash in the second month? What proportion of the first month's sales will be received as cash in the second month? So, percentage wise, we need to calculate. There is no amount of sales which is mentioned. We are only given that a particular percentage of the month of these sales is received in the same month, right? Then something is not received, which is 20% are bad debts. 45% of the total amount of sales are received in the same month. 20% of them are bad debts, and there is 10% discount for settling account within 30 days. Now, discounting feature is, see, generally when credit facility is given, we tend to observe that the customers, even if they do not intend to buy also, because the credit facility is given, they get attracted and they buy the product. So that is a strategy which is adopted to increase the sales. So if sales are made on credit basis, sales will increase, more number of customers will buy. But yet there is a problem there, which is they will not have any cash with them, because the customers will pay after a period, after the credit period. Credit period could be 1 month, 2 months, or 3 months, or whatever is that. So at the end of the credit period, they make the payment. So during the period, during that credit period, they will not have cash available with them. So when they do not have cash available with them, they have to borrow it from outside sources. When they are borrowing it from outside sources, in that case, uh, they have to pay interest on the borrowed amount. So that is resulting in additional cost for the business. So for that reason, they also adopt a second strategy. First strategy is selling goods on credit basis, so more customers get attracted. Second strategy is, so they say that the credit period is 30 days, but if you pay within first 10 days or first something within 1 week, if the payment is made, you can avail a discount of some percentage. So that is the second strategy. So to avail the discount, even if they have purchased it on credit basis, they tend to make the payment within the due date. So let's say that if sales are made and they can pay after 1 month, so that facility itself attracts the customers. They come and buy the product. The second strategy is, they say that yes, you can pay after 1 month, but if you pay within 1 week, you can get a discount or some percentage. So here on that note, it says that 10% of the total gross sales value is offered as a discount to the customers if they pay within 30 days. So that is another strategy. So altogether, how much do they receive? How much, what is the percentage? Here it says that what proportion of the first month's sales will be received as cash in the second month. Okay, the credit period is actually 2 months. They are allowed to pay after 2 months. So at the end of 2 months they can pay. But if they pay within 1 month, that is within 30 days, they can get a discount of 10%. So that is what is mentioned there. Do you understand that? So apart from this, the sales amounts are not given. So we can start off with an assumption that let sales be some X amount. So let's say, like, we can start with 10,000, 100, or anything, some. Okay. For example, if we take sales to be as $100, if we take, so how much will be received in the same month? the same month amount what is received here is, it says that it receives in cash 45% of the total gross sales value in the month of invoicing. So same month they will receive 45, 100 into 45%. So 45 will be received in the same month. Okay. So here it says about receives. So how would they receive? They will receive availing this 10%, because technically the customer is allowed to pay at the end of 2 months. But if the customer is paying before the 2 months period, within 1 month, if 45% of them are paying, we are receiving the amount, the business is receiving amount from the customers. 45% of the customers are paying, but they will pay at a discounted value. What is the percentage of discount? The discounted value is 10%. So after deducting the 10% only, they would be paid. Okay. So this 45% is after a discount of 10%. Okay, the sentence says that it receives in cash 45% of the total gross sales. So what is received? 45% is received. Who would pay? The ones who are availing the discount only will pay during that. So if 45% of them have paid, they have already availed the 10% discount. So this 45% is representing 90% of the sale value. Okay, 45% of the credit sale. I don't know whether you're able to follow. If you do not follow, please ask me. It is not a simple concept that you can understand it in the first go. So even if you do not understand, you feel free to get the doubt clarified. Okay, so step by step.
45%, that 45% of total sales, this after deducting that 10% only, they are calculated.
That's right. That's right. So what is received is calculated. What is received is what percentage is. We have to understand that. So let's start with. Let's mention the term so that it will be easier. Credit period. Credit period is 2 months. Okay. Then if it is 2 months and cash received represents 45% of total sales, that is gross sales is before deduction. Cash received represents 45% of sale, and cash received in the first month. Very specifically we have to mention cash received in the first month. Okay, in the month of invoicing. Okay, cash received in the month of invoicing. Okay, it represents 45% of the total sales. Okay, then cash discount. Cash discount is how much? Is 10%. Okay, to start the solution, let amount of sales during a period, during a month, be $100. Okay, so if 45% is collected during a month, okay, amount collected during a month is equal to $100 into 45%, which is equal to $45. Okay, I hope till here everything is clear. But $45 is, if it is collected, it is after discount. So this 45 is after availing 10% discount. Done. Now, amount collected during a month is equal to $45 after availing a discount of 10%. But If discount availed is 10%, which means that what is the value before the discount? So if this is after availing discount of 10%, what is the value before discount? Okay, the amount before discount. Amount of sales before discount. How do we calculate? Anyone knows the logic?
90%.
Yeah. 45 represents 90%. So 100% is how much? The logic is, see, if they have received 45, 45 is after availing a discount of 10%. So this represents only 90%. So because 10% discount is already received. But before the discount,
200?
what is? No, 100%. This is before discount is 100%. So this 100% is what value? If they have already availed a discount of 10% and 10% is deducted, so it is only 90%. 90% of that amount is 45. So 100% of that amount is how much? Is 50. I'll put the calculation here. 45 into 100. 45 into 100 divided by 90. So this is equal to 50. The question is asking us to find out about what is it in the second month. So of the sales, a part of it is received in the first month because they want to avail a discount within the 30 days. So a part of the sales out of total 100, 50 are received, 50 related to that transaction, 50 it is received in the first month. Then 20% will not be received, 20%. So let's also write what is the bad debt. Irrecoverable debts. Irrecoverable debts represent $100, $100 into 20%. So that becomes is equal to $20. Anyway, that would not be received. Already out of 150, $50 worth of it is received during the first month. So the rest of it only will be received during the second month. So that is the point. So amount received in the second month. Amount received in the second month is equal to, out of total 100, $50 worth of it is already collected during the first month minus $20 would not be collected because of bad debts. So how much is received? It would be only 30 in the second month. So here they are asking us proportionately what percentage. So proportion would be 30 out of 100 is 30%. Proportion the classes are getting recorded, so I will also send the recordings to your concerned faculty. If you have a doubt, you can definitely refer back to the recording and then try to understand the explanation. Okay, given the limited time, I have to justify for the all the questions, so I cannot spend a lot of time on each question. So the Excel file also will come to you, and also the recording, the class when it is taken, it is being recorded. Yesterday also I've recorded, today also. So if you have a doubt, you can refer back to the recording and then try to follow what is the solution. We'll move to the next solution. The next question. Spears make gross sales of 40,000 per month, of which 10% are for cash, the rest are on credit. Experience shows that the credit sales are received as follows. Receivables paying within 1 month is 40%, 2 months is 50%, settlement discounts for payment within 1 month is 4%. What will be the total expected cash receipts in any month? Okay. The gross sales, the details given are gross sales are on an average every month they have 40,000 per month of sales. Then 10% are for cash. So 10% of 40,000, 4,000 is on cash. Immediately they receive cash. So how much is on credit? If 4 is deducted, then 36 would be on credit. Okay. 90% of 40,000 is on credit. So credit sales will be 36,000. Out of this 36,000, it says that 40% of the credit sales will be received. No. Okay, receivables paying because 40 plus 50 is 90, 10%. So 40% of 40,000 for fours are 60. 16,000 will be paid, will be received within 1 month. 50% of 40, that is 20,000 will be within 2 months. So 40, 50, 90, 90 plus 10, 100. So total 100% settled. But here there is one more thing which is settlement discounts for payment within 1 month. So the ones who are paying in the first month also will avail a discount of 4%. So after the discount percentage, what is the rest of the amount? So what will be the total expected cash receipts in any month? So in 1 month, let's say the first month, so a part of it is any month, the first part of it is 10% on cash, 10% will be on cash, then 40% in the next month, then 40% next month, 50% 2 months later. Okay, 50% 2 months later. That is how it is split into. Now, if we are looking at the collection part of it, the collection would be the same month 10%. Okay, previous month 40%, 2 months before that 50%. The collection is spread as same month 10%, 40% next month, then 50% after 2 months. So when we are finding out what is the amount of cash receipts in any month, we have to look into as 10% as cash sales of the same month, from the previous month, from 2 months prior to this month, amounts are received. So that is how we have to look into the collection part of it. Okay, shall we start? Cash collections. The solution is for question number 296. Cash collections during a month. So first part of it is 10% is received in cash. So cash sales. Let's write cash sales. What are cash sales? Cash sales are 10% of the total amount, which is 40,000 into 10%. So is equal to 40,000 into 10%, 4,000. Then let's deal with the credit sales. So credit sales are now spread in this particular fashion. 40 in the next month, 50 after 2 months. So when we are collecting, it goes the other way around. So anyone can help me? 40% of the previous month, 1 month before, no? So we have to look into 40% of the previous month. So if they are paying within 1 month, they can avail a discount of 4%. You understand that point?
Yes, ma'am.
They can avail a discount of 4%. So what percentage of the amount will be paid? If 4% is deducted, only 96% of the total amount due will be paid. So cash receipts from the previous month. So I'll write the calculation here. Any month it is 40,000. Out of that 40%, out of that 96%. I'm erasing this, the one which I wrote it with the marker. Okay, so 40,000 is any month sales. 40,000 into the collection part of it is 40% of the previous month, and then they would not pay 100% of the amount, they will pay 10% discount. So it is only 13,360, 15,360. Then cash receipts from 2 months prior, from sales of sales made 2 months prior. So cash receipts from sales made 2 months prior. For them, it is 40,000 to 50%.
$20,000.
When you add them,
39,360.
there's no answer matching there.
Ma'am, I think we have to do the credit sales, the 40% and the 50%
See,
on
if
36,000.
if that is the case, if we are doing 40% of the remaining 36,000, then 36,000, 100% we have to justify, isn't it? 36,000 into 36,000 should be split into 2 parts. So that 2 parts should total up to 100%. So technically, that would be the issue. Initially, even I thought it is 36,000 because when we add these percentages, they are adding up only to 90%. So that's an issue there. What about what is the other 10%? There is no mention about the other person. Experience shows that the credit sales are received. Okay, credit sales are received. Credit sales. Okay. So there is no mention about what happened with those the remaining 10%. But because it is only the credit sales, let's also write it here. What are credit sales?
Ma'am, the other 10% is cash, the cash sales,
No,
right?
no. See, the point is when they are separating. So even if you look into that, 4,000 will go here. Okay, technically, let me put it across so you will also understand that. See, out of 40,000, first thing is 4,000 is going here. Then 36,000 into 40%, ignoring all the discounts and all. Technically, let's look into that. 36,000 into 40%, just tell me how much is that?
14,400.
14,400. 50% is 18,000. So we do not see that adding up to 40,000. Do you see that the difference? So which means
Right.
that
Yes, ma'am.
the rest of the 10% they have not mentioned. Maybe it is bad debts or something, but there is I mean one point which is missed here. So even in your exam also you have to cross verify it. Unless I mean here it is very specifically they have mentioned it as credit sales, so we are going with the credit sales, but otherwise all the percentages added up should be equal to 100%
100%.
and 40,000 part of it. Okay, so that is the issue here. But because it is very clearly mentioned that it is credit sales, we are ignoring what happened to that 10%. So ignoring that, let's go ahead with that. So credit sales will be 40,000 into 90%, which is equal to 36,000. So 36,000 here it will be calculated as 36,000 into. Okay. Do we have? Yes. 35,824 is cash collection during a month. Question number 297. Selected figures from a firm's budget for next month are as follows: sales, gross profit on sales, decrease in trade payables over the month, increase in cost of inventory held over the month. What is the budgeted payment to trade payables? Now here this one is about the payments part of it. So what are we having? We have the sales figure, we have the gross profit percentage. Gross profit on sales is 30%. So cost of goods sold will be 70%. Fine, that is the case. Cost of goods sold is 70%. And other details are decrease in trade payables over the month is given to us as 10,000. Increase in cost of inventory held over the month is 80,000. So what is the budgeted payment of trade payable? Trade payables. Any clue? The clue here is, first thing we need to find out what is cost of goods sold. Okay, if gross profit is 30%, the rest of it is cost of goods sold. So see, in a trading account, we have so many costs, all these things, opening stock, the other things. Then we have sales. Then we have closing stock. Okay. Then we have gross profit. So sales minus gross profit is the rest of it, which is cost of goods sold. If sales is 100%, gross profit is 30%, the rest of it, cost of goods sold, is opening stock plus purchases minus closing stock is cost of goods sold. So that represents 70%. So that part of it is fine. So 70% of 450,000, let's calculate what is cost of goods sold. This is question number 297. Cost of goods sold is equal to 450,000 into 70%, which is equal to 315,000.
Yes.
After that, decrease in trades payable over the month and increase in cost of inventory over the month. So what are these things? What are trade payable? Trade payables are the other term or the westernized terms which are used for sundry creditors, sundry debtors. What we Indian version of these things is sundry creditors and sundry debtors. Sundry debtors are the credit sales amount. We write it as sundry debtors, and then sundry creditors are the suppliers who supply the material on credit. We call it as so. To them, on account of trade, the meaning of trade is buying and selling. On account of buying and selling, if there is something payable, it is sundry creditors. So when two periods, at the beginning of the period, end of the period, when the amount due to the suppliers is compared, it has decreased. So what does it mean by decreased? Decreased is they have paid. That's why it's decreasing. Let's say it was 50,000 at the beginning of the period. By the end of the period, it has become 40,000. So it has reduced by 10,000. So reduced by 10,000 is they have paid the amount. So it is a cash payment.
So we have to add.
We have to add. This is the cost which is incurred to meet all the other things, like they have paid for material, wages. There's so many things. So the cost of goods sold, payment for cost of goods sold is 15,000 plus add decrease in trade payables. So that would be 10,000. What about the other one? Increase in cost of inventory held over the month. So whatever inventory which is purchased, the closing stock, what we call it as. So that stock has increased. Why would it increase? It would increase because they have purchased it. Okay. So it is an additional purchase. When it is a purchase, it is a payment. Okay. Unless and until credit terms are there, because there are no credit terms given, we are assuming that the purchase was made on cash basis. So add increase in inventory. That's it. Again is okay. That is 18,000. Okay. So just add them up. Add all the three figures, and that would become the cash payment. Budgeted payment to. Okay. So
3,43,000.
yeah. Budgeted payment to trade payables. Okay. As many as I can do in this class, I'll finish. The rest of it you have to work out because we've spent already
Ma'am?
2 days. Yes.
Ma'am, in this question, you said that cost of goods sold is sales minus gross profit, no?
Huh.
So here but here we calculated like 4,50,000 into 70% we did.
Sales, if it is taken as 100%, gross profit on sales, the percentage on sales is 30%. On sales base always is 100%. So sales is 100%, gross profit is 30%. So cost of goods sold is 70%. 70%.
Okay.
On sales, so the base is always 100%. So on sales will become 100%. If sales is 100%, gross profit is 30%, cost of goods sold is 70%. Because the equation says that cost of goods sold is sales minus gross profit. Okay. There are so many, every question. Yes.
The previous solution just once, ma'am.
You want me to explain the solution once? Yeah, done.
No, ma'am. No, ma'am. Just show me the previous one solution. I mean, to 96.
This one.
Yes, ma'am.
Don't worry about this. I'll send this file
Thank
to
you,
your
ma'am.
faculty. Faculty will share it with you. The Excel file will come to you. The recordings also will come to you. The class is getting recorded. So this recording also will come to you for your reference. I know I'm going at a very fast pace, but then given the time constraint, we can do only at this pace. I mean, unlike the way, I mean, the faculty pampers the kids in doing write it on the board, erase it, all that gives a lot of time to copy down all that. So that provision is not there. Right from day one, you students, that is IFA students, have to understand that you have to follow the space. If you have to clear all your papers within that specified time period and then be placed well, you have to follow the space and then do like this. And form into groups. I mean, you may say that we are there already on WhatsApp. I'm not talking about that WhatsApp group. Maybe 4 students, 5 students come together and start working out. So each one can help. If question number 1 is clear to one student, 4 will be clear to another student. So each one of you mutually can help the other ones, and you can answer all these questions. So if you're thorough with the exam kit, the chances of you clearing the exam is quite bright. Okay, so please work out all the questions as many as we can do as faculty. Given the time constraints, we will do, but the rest of it is your responsibility. So you have to also take up the responsibility in working out the solution. Okay. 298, a company has a current cash balance of 7,000, trade receivables of 15,000, trade payables of 40,000. The company can sell goods costing 50,000 and 70,000 next month. One half of all sales are collected in the month of sales and the remainder in the following month. All purchases are made on credit and paid during the following month. Inventory levels remain constant during the month. General cash expenses will be 60,000 during the month. So this is again cash collection, all those things. So all the rest of the questions are related to cash budget. I've put all these questions here. Okay, so you can work out those questions. One more thing from budgeting. Let's work out one flexible budget question. What is the meaning of flexible budget? The process of preparing budgets, we call it as budgeting, isn't it? So the cycle goes in this fashion. First, budgets are prepared. Either it is authoritative style or it is participative style. No matter what is the style, budgets are prepared. Okay. Then after that, first budgets are prepared. Okay. Then the implementation comes. So implementation, at the time of implementation, I have mentioned that the budgets are compared with actual. Budgets are compared with actual. There is a comparison made. And if the actual is not going on par with the budgets, so that is noted down as a deviation arising. So continuous monitoring, a deviation is noted down and it is communicated to people who are implementing it, and the deviations are corrected if needed. And finally, they also revise the budgets if needed, if they are not possible to be achieved. So that is again a rare situation. So the important point here is, for the comparison, the budgets are used for comparing the actual results. So that is the main part of it, which helps in the control part of it. So when the comparison has to happen, comparison should always be on par. That is important. See, when budgets are prepared, but how are budgets prepared? Something is forecasted for the future. The forecasted figures are taken, the forecasted estimations are taken, and the activity level is decided. So some activity level or some number of units are anticipated to be sold. Therefore, they prepare a budget for selling those many number of units. What are the various costs are all anticipated. So the revenue is anticipated, the costs to generate that revenue are also anticipated and then prepared. But future is uncertain. Yesterday also we've discussed future is uncertain. So whatever is planned, not necessary that the same thing would happen in future. Here also the example, it says that they have planned at 120,000 units. They have planned to sell 120,000 units. But it is not necessary that they would exactly be able to sell 120,000. So it could be any reason, but whatever is planned, not necessary that it would happen. So in reality, what has happened? They were able to sell only 100,000. So all the costs which they have anticipated are at 120,000. The actuals happened at 100,000. So are they comparable? Is it possible to compare 120,000 and 100,000? Now you are in semester 1, isn't it? So semester 1's performance, is it possible that we can compare it with someone who's doing semester 3? There are different levels. Semester 1 and semester 3 are on completely different levels. It is not fair that we compare the performance of semester 1 student with semester 3 student. So it doesn't work out that way because of so many reasons. So if they have prepared a budget at 120,000 and when the actual happened at 100,000, it is not appropriate to compare both the things. So therefore, what has to be done? What has to be done is the budget has to be revised according to the actual. So whatever figures which they have prepared at 120,000, these things have to be adjusted to 100,000. So the process of adjusting the budgets according to the actuals is called as preparation of flexible budgets. Okay. So another instance is they anticipate multiple activity levels and all multiple activity level figures are prepared beforehand, or they wait until what the actual happens. So here the actual is 100,000. So the budget was anticipated at 120,000 units. So 120,000 units, the costs are given. Then the actual happened at 100,000. So the budget will be revised according to the actual. So it would be at 100,000 units. So that process is called as preparation of flexible budget. So now we are preparing the flexible budget. The activity level is at 100,000, budget is at 120,000. So that is the key point. Then in this context, one more important point what we have to remember is there are two different types of, there are basically three different types of costs. Based on the behavior of costs. So there are three different types of costs. One cost is called as variable cost, another cost is fixed cost, another cost is semi-variable cost. So variable cost is a cost varies proportionately, fixed cost is a cost which remains fixed no matter what I say activity level until the maximum capacity level. Fixed cost remains fixed, variable cost varies proportionately. So out of this list of costs, we have to first look into what are the variable amounts, what are the fixed amounts. So the first two are variable. This is variable because it's very specifically mentioned, variable. So variable cost varies proportionately. Fixed cost does not vary. So it remains fixed. So whether it is 120,000 units level or it is 100,000 units level, it would remain the same. So now when we are preparing the flexible budget, for let's write particulars. For the sake of having that information, let's put it as 120,000. This is units. This is the budget. Then we have the flexible budget. Flexible budget, now they have to adjust it for how many units? 100,000 units. Why? Because the actuals are at 100,000.
How flexible is the difference of actual and budgeted?
No. Flexible is adjustment of budget according to actual. Adjustment of budget, revising of the budget according to actual. Actual happened at 100,000 units. So the plan which is prepared was at 120,000. So that 120,000 is adjusted to 100,000.
Okay, ma'am.
Okay, so let's first list out all the items in the budget. Sales is given. Sales is 1,200. Then we have variable printing cost. Variable printing cost is 360. Then we have variable some cost, production cost. Variable production cost is 60. Then we have fixed production cost. Fixed production cost done. Which is 300. Then fixed administration cost. Which is 360. These are the things. So now what is the profit? Profit is sales minus all the costs. So their profit as of now is 120. Fine. The actuals are at 100,000. The figures given are 995. Okay. Then 280. The actuals. Then this is 56. Then this is 290. And this is 364. So we see that the profit here is 5. Now we have to revise. So we are revising, we are adjusting 120 to 100. 1,200 is the sales at 120,000. So at 100,000 units, how much would be sales? How much would be sales will be proportionately. Proportionate will be, see, it goes like this. So 120,000. 120,000. If the sales is 1,200, for 100,000, how much? That's the logic. Proportionate, isn't it? So this is how much. How do we calculate? We just multiply 100,000 into 1,200. 1,200 divided by 120,000. Okay. Variable cost also varies. Variable cost also varies proportionately. The same logic for variable cost as well. But fixed costs, it remains same. So fixed cost of 300 and 360 will remain same even if the activity level has reduced. Okay. So now in that case, the fixed cost will remain same 300 and 360. In that case, they actually have a loss of 10. Do you see that? So what does the flexible budget show? The flexible budget shows a loss of 10,000. So only point what we have to remember under flexible budget is flexible budget. We have to remember that there are two different types of cost, variable cost and fixed cost. Variable cost and sales vary proportionately. Fixed cost is a cost which does not vary. It remains fixed. So the fixed components will have to be written same for whatever is the activity level. Then the variable component and the sales, the selling price per unit is the same, will remain the same for the next activity level as well. Okay. I mean, will have to be changed proportionately for the next activity. Fixed cost remains the same for the next activity. Variable cost varies proportionately. So after that, I understand that there is a loss of 10,000. Okay. So there are, these are all the questions what are there. So there's another question here. You can also work it out. Okay. So I've taken you through the budgeting part of it. All the topics of the budgeting are covered. So the rest of the questions, whatever are there, you have to work it out. Okay. Please form into groups and then keep studying. I will ensure that this this is received to you at the earliest. Maybe today, tomorrow, you will get both the recording and the Excel file. So keep it for your reference sake, and then the rest of them, some of them I have not worked out. But I gave you the base and the understanding of how to solve the questions. So with the help of that, you please sit and work out the questions. Okay. Any doubts?
Ma'am, I have a question
Yes.
doubt in question number 292.
292. Okay.
Yeah, ma'am. So here they said the estimated value is 25,000. So even after all the percentages, and he didn't give 5%, he gave 95%. So even if we take that 5% into consideration, we will not get 25,000, no, ma'am. So
Maybe
how
that
will
5% is cash sales. So the missing figures could be something else. It could be inferred to be as cash sales because they are discussing only about the credit sales. His credit sales are as follows. So the rest of that 5% could be cash sales. That is one thing we can.
So do we have to assume it?
How it is an because we are asked only to find out what is the expected collection from the credit customer. Only very specifically credit customers. So it's only addressing one issue, which is credit customer. So the credit part of it only we have discussed. So what is the total collection during the period is even the cash sales also has to be taken.
Okay, so that 5,000 could be the cash
5%
sale,
could
is
be
what
cash
you're
sale.
saying.
Yeah, yeah.
Okay.
Because the
Okay.
question is very specifically addressing about the credit customer.
Done. Okay, ma'am. Thank you.
Okay. Anyone, any faculty there in the class? Shall I end the class? Or anyone is there in the class, faculty?
No, ma'am.
No, ma'am, no faculty.
Fine, all the best. Keep studying well. Keep working hard.
Thank you, ma'am.
Okay. Good day.
Thank you, ma'am.
Thank you.
Thank you, ma'am.
You may leave the class.